Welcome, everybody. I'm glad to have you join us here today for our pre-deployment event on preparing for a seed round. My name is Jake Dooley. I am the pre-deployment program manager here at LocalVest. LocalVest is a marketplace where we allow veterans to invest with other veterans in their business ventures. And my role is to help make sure that companies are prepared to raise capital on LocalVest and really anywhere they want to raise capital. And today's event, we're going to go into one of those items in detail, provide some education for you when it comes to getting ready to raise capital. In fact, a lot of times we get a large number of discovery calls in trying to raise capital, and they're not quite ready to do that raise. A lot of you end up with a foundation that has a great business that's ready to go. You're a founder that's ready. You have a solid idea and ready to go to market, but there's something that's missing in one or more categories, and we really narrow them down into 4 categories. And so I want to explain those 4 categories today. So if you see in legal to raise, we find that some companies are not set up with the right legal entity, or they don't understand which SEC regulation they need to follow. Some of them are very simple, some of them are very complicated, all the way out to having to file with the SEC before you go. Some companies have questions on how much they need to raise in the financial instruments. So setting a budget. Have you modeled out what you're going to need, not only next several months, but the next few years? How much do you need to raise in this round? And then how do you end up doing the financial instruments? Do you need to use a convertible note, a safe? Do you need to allow for employee stock options? And what does that do to your cap table? And all those preparations involved with that. And then there's the element of actually being able to sell. So the pitch. So that's anything to do with the documents that you need, the presentations you have. And now some of you have created those documents, but then the question is, have those been vetted by people who look at those every single day? And is it going to be what investors are asking for in that presentation? And then, of course, there's the investors' interactions themselves. And so questions, not only where do I find investors, but how do I get them to attend a pitch? What should I do with them while they're in the pitch? And then after the pitch, how am I supposed to approach those companies and actually move from I'm interested, I like what you're saying, to them giving you a check as part of your capital raise? So all the questions that come, we find, usually fall into one of those buckets. And if you're missing one of those items, one of these 4 pillars of raising capital, it's that much harder, if not impossible, to actually raise the capital you'll need to continue to grow. Now, what we're doing here with the pre-deployment program at LocalVest is creating a raising seed capital course to get you ready in all 4 of those pillars. So what we're going to do is have a module for each of the pillars. We have pre-recorded material that we're going to go through, and then we're going to meet live and have industry experts come in who have done something related to those pillars, and they're going to go through that material, and you can ask them all the questions that you want to about that topic. But then even more importantly, what we're going to do is have the ability to have one-on-one sessions. You can go and ask those experts about what help your company needs and do physical workups on your company so that you're ready to raise capital. We're going to be meeting every 2 weeks on Thursdays from 1 to 2 Eastern on November 3rd, the 17th, December 1st, and December 15th. Now, when it comes to the benefits, as I said, you're going to get tailored one-on-one time with experts. So if you're weak in an area, you can ask them questions about your company. If you need a lot of work, they'll give you opportunities to be able to have a further discussion so that you're ready to go in each of those elements. You're going to have pitch feedback. So before you're actually going out raising, you can talk with investors who see hundreds of presentations and tell you what needs to be fixed, what goes really well, where they're confused. Really valuable, so you're not doing that, the first time that you're giving that presentation is when you're trying to raise. This is a great feature. 3 months of 10X Vets membership will be included as well. You cannot underestimate the power of a veteran helping another veteran. And that's not only for raising capital, it's for any part of your company as well. I know I've been a member for over a year now, and the value it's given me to my career and to business has been absolutely amazing. And so you're going to have the ability to test that out if you don't already have that capability. And then the best part too is any tuition money that you put towards this course, you can apply to a future local best promotional package. We can get you in front of investors. We want to make sure that you're ready to put your best foot forward, do it effectively, do it legally when you're standing in front of that investor, and know that you're okay doing so and have that confidence. And so that's what the Raising Seed Capital course is about. At the end of today's presentation, we are going to, as always, send out a recording of what we have here. You're also going to have a link for learning more about it to a website, as well as to a survey that you can take. Schedule some time if this seems like it's something that could really benefit you in preparing you to raise seed capital. Now, what we're going to do in our course today, or during the presentation today, though, is we're going to focus on one of those pillars. We get a lot of questions about this legal and regulatory side of things. Am I doing it right? Am I set up right? Where am I potentially making a mistake? Because you don't want to get in trouble. And so we have today is Max Moyer, and he has come in and he is going to give us some information about it. So I want to give you a little bit of background about Max. So Max is the founder of Triumph Law. He spent over a decade practicing corporate law at top law firms within a startup company, and then now on his own. And he helps growth companies, their founders, and stakeholders navigate every important stage of growth from inception to exit. Max started Triumph Law to focus on venture capital and private financing, startup and high growth company representation, investor counsel, mergers and acquisitions, and day-to-day general corporate and contract work. So if you are a startup, he can help you out from the legal perspective, and he has the experience to go with it. He served as a general counsel at a number of startups, and previously he practiced law at Cooley and at Holland and Knight. He is a DC native. He earned his JD from Vanderbilt University Law School, as well as a law and business certificate from the Owens School of Management. One logistics note before I hand it over to Max is I'm going to ask him some questions along the way. I'm very interested in what this topic going here, but I bet you do as well. If you have questions, go into the chat feature, put them in there, and as he's talking, I'll be looking and pulling the best ones out there. I'll get to as many of them as I can in the time that we have allotted today. So use the chat feature. All right, and that is all for me. And so great to have you here, Max, and I look forward to it. I will turn it over to you.
Terrific. Thank you for the introduction, Jake. And thank you to everyone who took time out of their day to be here and to join this. I'm happy to be here. As Jake mentioned, the overview topic here today is seed investments, what that means, how they apply to early stage companies and startups. And we're going to do a little bit of a dive into the different forms that seed capital can take. But before we do that, we're going to start off with some trends. Where we are today, where the market is today. It's obviously been an extremely eventful last few years for our country and for financing. That is especially true as it relates to 2021, which in the big picture was actually a huge boom in the fundraising, startup, and venture scene. And some of that maybe because of pent-up pandemic demand. Companies and investors that kept some cash on the side, not knowing what was going to happen with the pandemic. But it translated into a ton of activity, some runaway valuations, and that has shifted, as many of you have heard in the news, starting really with Q1 this year. We have entered a new phase here. But before we kind of dive a little bit into some of the more somber news, there is actually still good news. And that's this first chart to the left, which tells us that while we're not getting some of the silly founder-friendly deals that we saw in 2021, when capital in some cases was almost free, what this chart is showing us is that there is still founder-friendly deals, and we're still, in terms of the spectrum, on the founder-friendly side of that chart, which means mostly on deal terms here, to some extent valuations, but more on how the deals are structured and whether they are set up to promote the founder and the founder team and some of their terms rather than the investor. So that is a good news. And the question there is is this sort of the new era of investing? And you can see this trend has been moving in this direction for a couple of years. Is that where we're going to stay, or are these deals just sort of slow to adjust to the new reality, which is a tighter financial market and tighter terms? So we'll have to wait and see how the pendulum swings in terms of founder versus investor favorable terms, now that folks have become accustomed to some of the founder favorable terms. Okay, so shifting gears to the right side of this slide, venture funding is down. This snapshot runs through Q2 of 2022 and shows that both the deal count is down fairly significantly, and the funding level is down as well. So the volume and the count are both down. The piece of this puzzle that you're not seeing in this chart, and I'll go to the next one, is if you zoom back a little bit, we're not at historic lows. We're not at a place where all funding has dried up. In fact, we've pulled back mostly to 2020 levels. And again, this is sort of the broad view. Yes, deal count is down from where it was 12 months ago, but it's actually not far off from where it was 24 months ago. And over the years, we've continued to see sort of a growing momentum in the investor community and the startup funding picture. So the fact that we've returned to 2020 levels in a number of these metrics, and it's across phases. You can see angel and seed, early venture, and later venture are all sharing the same trend. But we pulled back to where we were about 24 months ago. The big question is going to be, does that continue to pull back? Do we, people talk about recession and where we are in that cycle. Does this continue to shrink, or does it sort of stabilize? You can see from 2017 really through the pandemic up until 2021, in terms of deal count, it's been up and down a little bit, but essentially stable and slightly growing. So that's the big question. Where are we? And we'll have to wait and see how Q3 and Q4 shake out. We should have some Q3 numbers here shortly. But that's where we are right now in context over the last few years. And then in terms of geography, what will not be surprising is California continues to have the lion's share of deals and investment. You can see here San Francisco and the Bay Area, as well as Southern California, make up a big chunk here. But the Mid-Atlantic actually has some strong representation, especially in New York. We're also seeing an increase in activity in Baltimore and the DC area. So that's good for folks who are local or regional to the Mid-Atlantic. But we're seeing a positive trend, which is funding and financing moving away just from this sort of single point of the Silicon Valley, where it used to be concentrated, to a number of different markets. So that's a good development. So what are our trend takeaways? There's still lots of deals being done. We're off the 2021 high water mark. Founders are still getting good terms. And the big question we're left with is, where are we in that cycle? Are we going to continue to see that erode a bit, or are we stabilized and going to return to sort of that slow growth trend in more dollars and more deals? So with that brief overview and jump into trends, we're going to shift gears a little bit and talk about seed investing. So first of all, what is seed investing? You've probably heard this term from a number of different folks, a number of different places. And I would say there are two ways to answer that question. There's a colloquial meaning of the term seed financing, which just refers to early stage investing. You may hear a founder friend or someone say, yeah, we did our seed financing before we went out to the venture capitalists, or before we did XYZ. And again, it just refers to any early stage investing, has been sort of slapped with the term seed. And then there's a more specific or legal definition, which refers to a pre-Series A preferred stock deal structure. And we'll go into more detail on what that means. But this more specific definition has been popularized over the last 5 to 10 years, and now makes up a bigger chunk of what people refer to generically as seed. So specifically, when we talk about that bigger umbrella of what is seed financing, that colloquial reference, what are we talking about? There are a few different formats this can take. The first, which is the simplest way to think about this, and you still do see some of this in early stage and family office and in angel investing, is a company selling common stock, if they're an LLC, just selling some of their interests. And an investor puts in some money and takes a chunk of the company. And ultimately, when there's an exit or an economic event, they participate, according to what they own. So again, it's the most straightforward way to sell part of your company. It's not the most common because there are other ways you can do it more simply. And for the sophisticated investors, there are not a ton of protections and upside built into that common stock or LLC interest purchase. The second and third bullets here are convertible instruments, and there are two primary ones, which you may have heard of: convertible notes and safe instruments. And these are both intended to be very streamlined, easy, straightforward. And the way they do that, again, we'll go into more detail, is by kicking down the road a lot of the decisions that are made as it relates to preferred stock and investor rights. Then we have two different forms of that sort of more specific legal definition, that Series Seed. One, which we'll talk about, SeriesSeed.com, is a website that has created, practitioners have come together and industry folks and created a standard set of seed documents. And they're intended to be more user-friendly than what has existed, and a little bit more streamlined. What has existed has been a set of venture investment documents put out by the NVCA, National Venture Capital Association, which is what you would expect to see in a Series A, Series B, Series C. And there's also a slimmed down version we'll talk about a bit. So that's a high level overview. Now we're going to talk through each of these formats in a little bit more detail. So we'll start with convertible notes. Big picture, what is a convertible note? These are debt instruments, and the special feature about them is they convert into stock at a future date. And the idea, as I mentioned, is a streamlined instrument that you don't have to negotiate every right that you'd expect to be in a preferred stock financing, because you're going to kick that down the road and let a future investor do all that negotiation, and these debt holders then convert into that instrument. So if I put in $100,000 into Rocket Ship Inc. As a convertible note, then I would expect my $100,000 to turn into Series Seed or Series A stock down the road when the company does that raise. There are 5 key provisions that show up in promissory notes. There's an interest rate, it's debt. So until it converts, it is a debt instrument. It has an interest rate, it has a discount rate and or a valuation cap. So my $100,000, if I hold on until a Series A, when Rocket Ship Inc. Raises money at $1 a share, I might get a discount on that. So my $100,000 buys me those shares at 80 cents a share instead of the $1 a share that everyone else is buying. So that's the benefit of coming in early. It could be a discount. It could be a valuation cap. So in that same scenario, if Rocket Ship's shares represent a $10 million valuation of the company, but I have a valuation cap of 8 million, then I would get that benefit of a lower cap, meaning a lower share price and more shares for my $100,000 than the other Series A investors are going to get. The convertible notes are typically triggered on what's called a qualified financing, and that's a negotiable term here. What is a qualified financing? How much money and what type of shares? It's typically going to be a preferred stock financing rather than common stock or another note financing. And then it could be triggered on $1 million financing. Maybe I want to make sure there's a lot of money in the company, and I negotiate for a $3 million qualified financing, meaning my note doesn't convert until the company has raised $3 million. So if they go raise 1.5 million as seed funding, my note stays in place. I still have the benefits of holding debt, but then if they subsequently do a $3 or $4 or $5 million financing, that's when it would convert. Maturity date, again, this is a note, so there's usually a date certain when something has to happen. Either the note gets paid back, it automatically converts into shares, or I have some ability to choose as an investor. Another provision that shows up sometimes is what happens if the company actually sells before they do a financing. So if it hasn't converted and they sell the company, then what happens to my note? And there are a few different ways to handle that, either getting 2x the face value of my note back to guarantee a return, or it could be that I convert at that valuation cap if that's part of the note. So a couple of different ways to handle that. The pros of these notes are they're simple. They put off negotiation on a bunch of the preferred stock requirements. You have to negotiate for a full preferred stock financing, and they're fairly common and recognizable in the industry now. There are some cons, especially for the company. You have debt out there, which means there's an exit. Those debt holders, especially if it's a not a great exit, or liquidation, the debt holders have preference over the stockholders. There is a maturity date, and lots of companies underestimate how long it will take to get that priced round, and they hit the maturity date and now need to figure out what to do with the $500,000 million they suddenly owe to their investors. Usually they're pushing it back or converting it. And if you don't get that cap right, if you use a valuation cap, sometimes, since this happens early in the company's life cycle, there can be a underestimation of the value of the company, $1 million cap that I then raise later at a $10 million valuation. And that's a 90% discount to what everybody else is getting. So that can come back and bite a company as well.
Hey, Max, I asked a question here on that maturity date. Right. So like you said, let's say I have like $1 million outstanding in that example that you had, and I haven't hit the qualified financing date, and then now I've got this maturity date staring down at me, like what's going to happen to me as a founder?
So that's a great question. And I'll address it from a couple of different angles. One is negotiating A, the maturity date, and B, what happens in the initial documents. It's not unusual to have a maturity date a year or two out. I always push the company, if they can, to do 3 or 4 years out, just to get some buffer in terms of when that date comes. But the other question is what happens on that date. It used to be almost ubiquitous that on the date, the money's due. That's changed a little bit to 2 different versions. One is the investors get to choose whether they called the note and or if they convert the note instead into equity. And then the third version is the most company favorable, which is if we don't have a qualified financing and we haven't sold the company on the maturity date, it automatically converts into equity. The issue with the first or second for the company is if you're a startup company and you have hit the maturity date without a financing or a sale, the chances are you don't have that cash on hand. And then best case scenario, you go to all your note holders and say, hey, this is taking longer than we thought. Can we push this out another year or two? They say yes, and you amend the notes. Obviously, there is some risk there if you have investors who have soured on the deal, need their money back, et cetera. The company can be in a tough spot. Now, none of these investors are in it for the 4, 5, or 6% interest they're getting. So you hope they'll be cooperative in changing the maturity date, but it is one restriction that you have to think about carefully as a founder. Okay,
and can you go in back again? I just see a question about that, the cap being punitive. Just going to say that again.
Sure. So if I just started my company and it's a software company and I raised $500,000. I'm just out of my garage. Maybe I give these investors $1 million cap. Now, what that means is when I get to a qualified financing, it doesn't matter what valuation I'm using. My investors will get the better of the share price and that valuation or the cap. And if you have a discount, they also get the better of the discount or the cap. But let's just focus on the cap. So if I have $1.5 million cap, and things go extremely well, and I go raise a Series A, let's say I raise it at a $30 million valuation. Well, now my $500,000 note holders are getting shares not at a $30 million valuation, which could be $10 a share, but they're getting at a $1.5 million valuation just because they came in so early. So when you try to estimate exactly what the company is worth with that cap, it can result in a huge discount to what a next financing would be.
Okay, understand.
And real quick, I'll just, the reason we got the caps, notes didn't used to have caps. It used to only have a discount rate. So I get a 20% discount on what the next investors raise at. But you did have some runaway valuations, and you had some of these early investors, again, given my scenario, saying, hey, I came in, maybe the company was worth 2 million, maybe it was worth 1 million. We decided on 1.5. But we know it wasn't worth anything close to 30. So if I just bought stock, I would have gotten way more bang for my buck. So the cap came in as a protective mechanism for the investors to avoid that runaway valuation scenario.
Okay.
All right, so we'll keep running here to the next type of convertible, which is a safe. Overview. What is a safe? It stands for Simple Agreement for Future Equity. This is a form of instrument that was pioneered by a Silicon Valley, a famous Silicon Valley accelerator incubator called Y Combinator. And the idea was, let's create a turnkey document for founders and startups that will let them raise money, again, quickly and simply. The NVCA documents I referenced can be very complicated. So this is an attempt to put the power into the founder's hands in a more founder and company friendly way than the notes. Now they share a lot of similarities to the note, as you'll see in these key provisions, but they are different. So there can be a discount or a cap or both. Last year in 2021, I saw the first instance of neither a cap nor a discount, which again is just free money. And it just converts whenever you raise the next round without any benefit. But those days are probably gone. So discount or cap, and there's no maturity date, no interest rate. We also have a new format of they call it post money safe, which works with a cap. And one of the drawbacks to both convertible notes and safes initially was you don't really know what you own. Again, in my example, if I put $100,000 into Rocket Ship Inc., I know it's going to convert at some point, especially if there's just a discount. I have to figure out what the next raise looks like to know what that discount is and what share price I get and how much I own. So one thing the post-money safe does is eliminate all of that uncertainty by saying the minute before you do that financing, that's when the valuation cap kicks in. So if I put $100,000 in Rocket Ship Inc. As a post-money safe with a $10 million cap, that means right before they raise their next round, I'm going to own 1% of the company, which is $10 million. My $100,000 divided by $10 million. So that post-money safe gives a ton of visibility into what I own as an investor right before that next financing. The drawback on the company side is that benefit comes at a cost, which is if I create more shares, if I do option plans, if I raise more safes, since I'm giving Max a 1% chunk of the company, no matter what, right before closing, all those things are going to come at the dilution of just the founders. So you have to be a little careful with the post-money safe that you're not, if you promise somebody 5%, someone 1%, and someone 10%, someone 12%, next thing you know, you have given away a huge chunk of the company. And the pre-money safe, which is less common right now, addresses some of that because there's no guaranteed ownership stake right before financing. It also takes away some of the certainty. So translating that into our pros and cons here on the safe, the pros are, again, super simple. It's one document. It says on there on the form, this hasn't been changed from the Y Combinator form other than, putting in the discount or the cap. And so the idea there is anybody can do it. Again, there's no interest. It's not debt, so there's no interest, and there is no maturity date. It doesn't come due. Then the flip side of that coin is there are some cons. It's not ubiquitous. There are still some people, I heard this actually this morning before I got on the call. There were some doctors who were looking to invest and they never heard of this thing called a safe and weren't really comfortable with it, wanted to do a convertible note. So that does happen. It's still not ubiquitous. There's risk for investors. Unlike the convertible note, there is no maturity date, no interest rate. So it actually hangs out there until you sell the company or do a financing. So that creates some risk for the investors. And again, the post-money safe can be dilutive for founders. So it shares some similarity to the convertible notes, but has some distinct features as well. And then one last thing, sorry. One last thing I will say is it is designed to be used by founders. I have a ton of founders come to me who have done safes and have no idea what they mean. Because when you read through it, it's actually still fairly dense and there's a lot of legalese. And so understanding what that means on a cap table for someone who may not have done a ton of them can be very complicated.
So if you go back to your example of the dentists or the doctors, or I can't, like I've never seen one of these before. I mean, can you force them to do it? It says, well, this is the only way I'm raising, or how should you approach that? So
it's a good question, and we get this question a lot. There's a blog post on our site called "The Safe Is It Safe," and basically talks about the compares and distinguishes between a convertible note and a safe. Some of what we just talked about. They are becoming much more common. I will say some non-sophisticated investors, especially folks on the East Coast and who may not be professional investors. In my example, that's who we had. For those folks, they don't know what it is. They haven't invested that way before. Their angel groups don't use these West Coast instruments. And so what I always tell people is it's better for the company. It doesn't have interest. It doesn't have maturity date. We had a client who, again, thought they were going to get to a financing sooner than they did and kept having to push back the maturity date, kept having to go back to their investors and say, hey, can we get another year on these safes? And they ultimately, I think in just in interest from those safes, had $500,000 that was going to roll into the next round. So there are some real drawbacks to having notes. Caveat is, if that's who you're raising money from, they like you, you like them, they're good investors, the money is available. I always tell my clients to take the money where it's available. You don't want to be the example of a company that goes out of business because you couldn't raise any money because you turned away people and insisted on your own terms. So typically, non-ideal or even bad terms are better if it brings money into the company than not bringing it in at all and dying on the vine.
Okay, there's some other questions that are in here. It may be a good time to do these. So one person asking, if you don't sell the company or do additional finance, what happened to the safe? Like my understanding, it's just out there until you have an equity conversion, correct?
That's right. And if you think about it sort of in big picture, for a company that is on this track, on this high growth fundraising track, that is an inherent risk in this type of investing. There are hundreds of examples of this, but as a private investor, if you're putting money into a startup, if it doesn't sell, you really aren't going to get any money back anyway. So yeah, it is sort of awkward that it just hangs out there. Again, if you own a convertible note instead that has a maturity date and is accruing interest, if that company runs out of gas, you're probably getting very little for it anyway. And most of these companies aren't designed to shed money through dividends, and they're not typically lifestyle companies that are going to generate a lot of cash going to investors. So I would say that is a risk, but in terms of this style of company and investing, it is a risk that is inherent regardless of if you're getting a Series C stock or Series A stock or Series B stock. If there's no exit, then there's no cash.
Okay. And I had someone asking too about if this is more typical of tech companies, or I don't know if it's that, or where it started? Like, are there certain companies it's better
Sure.
to use safes or not?
So it's not better suited for a tech company necessarily. It came out of the Silicon Valley, so yes, you do see a lot of tech companies there. The companies it's not suited for, per your last question, is a company that's on this sort of lifestyle trajectory. So we, not our most typical client, but we did a cidery, like a brewery for hard cider. And again, we've done a few of those types of deals, and it's a very different model. It's we're going to hold this thing forever, pass it down to our kids, and in the meantime, it's going to spit off some cash. So investors in that case are going to take some money as they go. That would not be a good profile for the standard safe, because it does require a fundraising and or an exit for it to ultimately work. But whether it's a high growth tech company, or it's a consumer product company, or name your industry, that doesn't matter as much as long as it's on that high growth path that is ultimately looking for exit.
Good. Thanks.
All right, so let's keep going here. I mentioned there are these two versions of true Series Seed transactions. SeriesSeed.com, as I mentioned, created a standard set of documents. When you talk about Series Seed stock, you're typically talking about a preferred stock. When a company starts, usually you only have common stock. The founders usually own common stock. Preferred stock is a new class of stock that builds in some rights and preferences. The SeriesSeed.com version of this does that through two documents. So I mentioned the more expanded version, NVCA, has 5 documents, Series Seed has 2. There's an investment agreement and a charter or certificate of incorporation. And those both contain some of these key provisions, which are, well, valuation is always going to be a key provision when you're talking about a price round or selling stock, because you have to set the value for those shares. But then there are economic rights. Typically, a preferred stock will have a liquidation preference, which means the preference at which money goes out to investors. What's standard right now, again, this reflects the more founder favorable deal, is called 1x non-participating preferred liquidation preference, which means investors get the better of their money back or the percentage of the company they own. I'll go back to my rocket ship example. If I own 1% of rocket ship and I put in $100,000 and they sell, if I had a seed shares with that 1x non-participating liquidation preference, I either get my $100 back or I get my 1% of the company. If they sell for $300 million, I'm obviously better with my 1%. If they sell for $20 million, I want to get my $100,000 back. No, it'd have to be below 10 million. So if they have a bad sale, I get my $100,000 back. So that's pretty typical. They don't get both usually. Other key provisions, governance rights. Again, these are usually streamlined stockholder rights to block a transaction, also called protective provisions. They usually get to participate in the next financing if they want to. And then one way that these Series C documents accomplish the streamlined approach is by promising future rights to investors. So they get whatever rights come in the next round as well, information rights or those ongoing participation rights. The pros of this approach is they're unambiguous. It's pretty streamlined, not quite as streamlined, and hard to do this one without legal support if you haven't done it before. They're fairly protective for investors if you negotiate them that way. The obvious cons are there's more involved. They do require sophistication. You're filing, creating new shares. They're not, this version is not quite as ubiquitous, the SeriesSeed.com one, so you might get some questions on the format. But overall, if you're raising enough cash here, then it might make sense to use the SeriesSeed.com format. And I also hear sometimes investors who want to own true equity. They don't want a convertible. They actually want to own shares. And sometimes you use the Series Seed to provide a more streamlined version of that. And then the last form of seed stock we'll talk about is the full preferred. There's a version of this we call preferred light. As I mentioned, NVCA has a standard set of documents for financing. There are 5 typical documents that go into there: a stock purchase agreement, a certificate of incorporation or a charter, an investor rights agreement, and a right of first refusal and co-sale agreement, and a voting agreement, if I skip that one. So those 5 documents, this is a lot more involved and expensive. It's not like there's a standard set of documents, but it's not quite like the safes where any Joe founder can pull these docs down and fill them out themselves. They're very involved. They're hundreds of pages altogether. I think they're each somewhere in the neighborhood of 20 or 25. So it's slower to negotiate them, less cost effective. I tend to recommend this format only if the investment amount is over a couple $1 million. Just doesn't make sense to go through all this negotiation for $1 million or sub-million. And then I still often will see a preferred light, which is a scaled back version of these in that seed format up until $4 or $5 million in investment, when it might make sense to be more prescriptive on all the rights. Key provisions here, again, valuation is the share price, some of the same things: economics, liquidation preference. Sometimes there'll be dividends in a full preferred round. Again, that company favorable, founder favorable version. Right now, it's unusual for dividends to actually get paid out. Sometimes there's a dividend in place in case one's ever declared, but it never will be. That's the most typical version of dividends we're seeing right now. There again, governance rights, these are all ratcheted up a little bit from the Series Seed. So those shareholder blocking rights, those protective provisions can get a little longer here. Investors might be able to block the next financing. They might be able to block taking on debt or changing the executive team. And then often there are board approval rights too, which get much more granular, where an investor representative who's now included in the board of directors will have rights down to changing comp and issuing options. And so again, this is the platform where a big Series ABC deal would get negotiated. It'd be typically based on these NVCA documents. Registration rights for an IPO, where investors can force an IPO at some point. Information rights. So there are a number of different things that can be negotiated here. Pros here are mostly pros for investors, which are it's more flexible. They can tailor the terms more protective, more detailed. The cons on the flip side is that it's costly, complex, and requires more additional negotiation. So with that overview, we've kind of talked through each of the different formats of seed investment we typically see. Before we wrap up, though, I want to also then touch briefly on another pretty common buzzword in the investing landscape you have probably heard and maybe heard here, which is crowdfunding. And actually, the term crowdfunding can refer to a lot of different types of crowdfunding, like your Kickstarters and your GoFundMe, charitable donations and whatever. But we're going to talk equity crowdfunding, which is a break from the age-old Securities and Exchange restriction on general solicitations, which came into place, way back when, as a response to, in the early 20th century, the 1900s, when snake oil salesmen and all these sketchy fundraisers were taking money from orphans and widows for fraudulent or extremely speculative ventures. So this is a break from that ban on general solicitation to the masses without a public financing. These are typically the crowdfunding buckets. There are 3 are typically referred to, and annoyingly to some I know, by the SEC exemptions, and they are Reg A, Reg Cf, and Reg D. Reg A offerings, you can think of them like mini IPOs. So an IPO, when you're selling to the public, requires audited financials and significant disclosure requirements. This is all scaled back. So these are mini IPOs. They let a company raise up to $75 million and two different 12-month tiers. So $20 million is the first one, and 50 million is the second one, up to 75. They're not super common. There are some industries where they're more common than others, such as real estate and other investing. The newest entrant on the scene is these Reg Cf offerings. So this is, you can think of it as retail crowdfunding. This is some of the sites you've seen where anybody can come in, put in 20 bucks, 50 bucks, 100 bucks, 1,000 bucks. There are some limitations to a Reg Cf. So you can go out to everybody and anybody. You can raise up to 5 million bucks. That's a new limit that was just increased from 1 million. And it can come from non-accredited investors. This is sort of an important distinction for Reg Cf. Typically, you would have to raise from accredited investors, which means people who have made $200,000 or more in the last couple of years, 300,000 if filing with a spouse, or have $1 million or more in net worth. The idea behind it, sometimes accurate, sometimes not, is that folks who have more means can hire specialists and by extension are more sophisticated than the general public. You do need an intermediary here, a broker dealer or a crowdfunding platform, and a lot of the online destinations for crowdfunding are that platform and build in a lot of the regulations. Then the third bucket is a Reg D, and this is the most common. This is sort of the mainstay of venture investing. Almost every venture capital investment and a lot of the other ones we've described fall under this category. It has to be accredited investors you're selling to. So you always see an accredited investor questionnaire and or a representation or warranty in those documents that the investors are accredited. There can be unlimited funds raised under Reg D, and disclosure requirements are limited. Again, the assumption is the investors are sophisticated, so you don't need to go through all the costs and expense of the detailed disclosures that are required for offering to the masses. So that's an overview. Just to put this into context, I just looked this up recently. The SEC, Office of the Advocate for Small Business Capital Formation, OASB, in 2021, published some stats here. So that Reg Cf that I mentioned, in all of 2021, $174 million was raised through Reg Cf. Now, it is a fairly new regulation, so that may be increasing, but $175 million is not a huge amount. The Reg A tier, 1.7 billion, so a big step up from Reg Cf, but still not a huge amount of money across the US. But then Reg D was $1.9 trillion. So as you can see, in terms of big fundraising, Reg D is still the preferred exemption there. So with that brings my presentation to a close. Hopefully there's some informative information in there. Happy to transition this, take any questions folks have, and then I'm pretty easy to find if after today there are other things that pop up as well.
Yeah, so actually there's a question that came up linking a couple of these things. So back to the safes and the convertible notes.
Yep.
And the question was, when you are pre-revenue, is there one that's preferred versus the other? Yes, no?
I mean, I always, on company side, I always prefer the safe. It's just more flexible. And again, the example I gave, if you're pre-revenue and can't quite get over the hump in the 2 years while that convertible note is out there, you get in that position of having to pay it back potentially when you may not have the traction yet. If you're already a revenue company and you're growing fast, it's more likely that you'll be able to hit some of those milestones in fundraising on schedule. And just generally, it's a more founder favorable instrument. So I would say safe if you can do it. Again, we probably do 90% safes these days over convertible notes for our clients. It's become sort of the favorite instrument for early stage, at least from what we see.
Okay. There were some questions on what triggers the safe to convert into equity. And one of them was, can you buy out the safe, right? And there was another one too on milestones that weren't converting to equity. Like there's certain sales projection revenue that that trigger that safe to convert? Does that kind of stuff happen?
So again, the safe, the sort of power of the safe is that it is that standard format.
Mhm.
That doesn't mean everybody uses the standard format. We will negotiate safe docs for clients or with investors with some regularity. So that's not to say they all work that way, but one of the big benefits is you can show up and negotiate two terms and everybody knows who's seen them before how the rest of the document works. That said, you can have them triggered on different milestones. What is the default is a sale of preferred stock in the company. It's called equity financing, is how it's defined in the safe, or a liquidity event, a sale of a company or an IPO. So that's the default, is that it triggers on one of those two things with no dollar threshold or minimum or anything. But all of these things are negotiable. And again, on the convertible note side, where there is no standard form, you may see a little bit more negotiation around that one.
Okay. So the old way, of course, started, you would just give common equity, right? We created the notes and the safes were a simplified way to avoid a lot of that. But are there cases where you would just say, I'm going to go straight to a priced round?
Sure. So usually these days it's a dollar threshold and or an investment requirement from your investors. So I do sometimes see investors say, look, that's great, you have the safe, you have the note, but I just want real stock. I want to be able to vote. I want to, have some of those rights. And so in that case, you may go to a Series Seed. Again, if you're raising $500,000, my recommendation would be don't go down that route. You're just going to spend a lot of time and money creating the documents, negotiating the documents, filing, but it does sometimes still happen. And then with a really hot company, or a company that's growing fast and hasn't needed to take in a convertible, you might jump straight to a priced round where you're raising, significant enough amount of money. But again, I would say most typical path we see these days is, whether it's friends or family or that sort of angel round, is some sort of convertible first.
Gotcha. And those safes have no, like you were saying, the advisory side of things is not in their board seat. It is a straightforward financial, and that's it, correct?
Yeah, that's right. So when you hold a safe, now there is a form of side letter that is also published with the forms of safe that gives pro rata rights. So that is one right that is common enough. They've created it as part of the standard set of documents. But otherwise, holding a safe, that's all you get. You don't get a board seat. You don't get special visibility into the financials. It is a sort of purely economic and future contingent instrument. So unlike a stockholder who has negotiated for a board seat or an observer seat, where they get to be invited to every board meeting, as a safe holder, you don't have a lot of rights.
Right. And one other two you talked about, we shift over to that the Reg A plus, I guess, when it goes through. I've heard they're really expensive. I mean, like a typical company is probably double-digit millions, or like what's kind of a profile of a company that would even go that route?
Yeah. So again, if you think of it like a mini IPO, a lot of that cost is in the disclosure. So making, the financials, having the financials in line, and then putting together a much more robust disclosure document with risk factors. It's a lot of legal time and accounting time. And so it does have to be a company profile where that makes sense as a structure. Again, I've seen it on the real estate side. We honestly have not done too many. It's not very common with our client profile, but it is, it is out there in certain industries.
Good. All right. Someone asked, what's the typical value of a safe? Are they like a typical size of?
I mean, I've seen people raise $5,000 to $10,000 on them, and millions. So it is super flexible in that pre-price round stage that you can really use it for just about any side investment.
Okay. Well, I think this is good. I know there's a few more questions, but we're getting close in our time, so I think I should probably wrap things up here. This has been really informative, Max. I mean, these are the types of things, I know these questions come up all the time. I'm sure you get them as well, but the right way to choose the instruments you want to do. And so I'm glad you're able to come in and talk about that. And I know there's a lot more, because you then have to do the math behind all of them and figure out what in the world does it do to you in each of these kinds. So I appreciate that you were able to come in here. Martha, if you could bring up, like you had mentioned, bringing up the slides. Some people had some questions, triumph.law. You can go to Max's site. He made some comments, the blogs. There's some of the posts. Some of the questions I saw are actually things I know that you've written about. So you can go and read there as well, a little bit more detail. Consent to ask some questions if it comes to that. And you can always ask us too, and we can link you up on that way. I did want to talk about here some future events that we have that are coming up as we get close here. I did mention earlier, I'll send you the links over, but we do have our course. We're going to go through this. Max is actually going to help us out in the course when it comes to that legal and regulatory. So you'll get to know Max even better and get some one-on-one time on there as well. Also that financial piece, getting the pitch ready, and what you do to interact with the investors. So that'll be going on soon. And we'll also have on November 9th, a very interesting way. It's a little different than our normal way of going out and just talking about an investment you can make or educating you on investments. Is we're going to do a Veterans Week event that includes the Grunt Style Foundation and a couple of other companies. And we're going to talk about veteran-centric things that have been in the news lately. So you read about the burn pits bill that came out. Also, we've got some things about the Camp Lejeune water that is all over, and why in the world that's all over the news and advertising, and what that means for veterans and how that affects them. Very important stuff about how that came into effect and what that means going forward. And they're going to talk about that. Our next launch with LocalVest, where we have investment opportunities, we have penciled in for December 7th, but that's still a little fluid. We'll check as we make sure on everybody's calendars, but we do have one of those coming out. I put in here with Bill, but actually let's go switch it up. I know John and Drazen are going to go to the Military Influencers Conference in Las Vegas at the end of October. I know it's extremely popular. I feel like I might be missing out. Maybe I should go. But a lot of people who are veterans that I know and include on military influence. I know there's several of you that are probably attending as well. So if you're going, you can look for some LocalVest representation that are there as well. All right, so again, for everybody, thank you so much for coming and attending today. You're going to get a recording of this afterwards. You have some links about the things for the course. You can always visit our website, log in, see what's out there from the investor or the issuer side if you're trying to raise capital. We always look forward to that. Have a great rest of your week, and thanks for attending.